Ryan buys a $350,000 rental property. Daniel puts the same $70,000 into a stock portfolio. 20 years later, one of them may look richer at a barbecue, but the other may have kept more freedom, more liquidity, and fewer 2 a.m. problems. That is why real estate versus stocks is not really a debate about houses and charts. It is a debate about which cost you can survive. For illustration, let's keep the starting point simple. Ryan has $70,000. He uses it as a 20% down payment on a $350,000 rental property. He finances the remaining $280,000 with a 30-year fixed mortgage. To keep the math grounded, assume his mortgage rate is around 6.75%. That is not a prediction. It is an illustrative rate because mortgage rates change, and Freddie Mac's 30-year fixed mortgage average published through Fred is exactly the kind of source you would check before using current numbers. At that rate, Ryan's principal and interest payment is roughly $1,806 per month. Now add the parts many people skip: property tax, insurance, vacancy, maintenance, capital expenditures, repairs. Daniel also starts with $70,000. He puts it into a diversified stock portfolio. For illustration, assume a 7% annual return before taxes and no additional contributions. Again, this is not a guarantee. It is a simple model to compare two paths. At 7%, Daniel's $70,000 becomes about $138,000 after 10 years. After 20 years, it becomes about $271,000. No tenant, no roof, no mortgage, no rent check either. Year 1. Ryan feels like he is winning. He has keys. He has a tenant. He has a rent check. If the property rents for $2,300 per month, the first glance looks good. The mortgage payment is about $1,816, so people online might say he cash flows almost $500 a month. But that is not the real math. The real math starts after the first lie in the spreadsheet. Property tax might be several $100s per month. Insurance might be another $150. Vacancy might eat 5% of the rent. Maintenance might require another reserve. A future roof, water heater, appliance replacement, or plumbing issue does not care that Ryan's spreadsheet looked clean. Suddenly, the $500 gap does not look like cash flow. It looks like a warning label. Daniel's year 1 feels boring. He buys index funds. The portfolio goes up a little, down a little, and gives him nothing to brag about. If the market falls 12% that year, his $70,000 might briefly look like $6,600. Ryan can drive past a house. Daniel can only stare at a red number on a screen. That is the first emotional twist. Real estate feels safer because it looks solid. Stocks can feel dangerous because the pain is visible every day. But visibility is not the same as risk. Year 3, Ryan gets his first real test. The tenant moves out. The house sits vacant for 6 weeks. Then the new tenant asks about a leak. The plumber finds a bigger issue. The repair costs $2,400. Ryan still owns the property. The asset may still be appreciating. But now he understands something most real estate pitches hide. Rent is not profit. Rent is revenue. Profit is what survives after the property gets paid first. The IRS allows many rental expenses to be deducted when the property is rented for profit, as explained in IRS Topic 415. But a deduction is not free money. If Ryan spends $1, he may reduce taxable rental income. He does not automatically get the full dollar back. Daniel's year 3 test looks different. The market drops again. He hears a podcast saying a recession is coming. Reddit is arguing about whether stocks are dead. His coworker says real estate is the only real asset. Daniel does not have to fix a pipe, but he has to fix his own behavior. If he sells during panic, the stock strategy breaks. The market did not fail. His discipline failed. Year 5. Ryan may look strong again. Assume the property appreciates from $350,000 to about $405,000. That is not crazy in a good local market, but it is not guaranteed either. Because Ryan used leverage, the gain feels powerful. He did not put down $350,000. He put down $70,000. If the house value rises by $55,000, that gain is large relative to his starting cash. This is the part real estate investors love, and they are not wrong. Leverage can be a wealth accelerator, but leverage also concentrates risk. Ryan does not own 500 small pieces of different companies. He owns property in one city, on one street, with one tenant at a time. One bad tenant can change the year. One local rule change can change the cash flow. One insurance spike can change the return. Daniel's portfolio at year 5 may be worth about $98,000 if the 7% assumption holds. It does not look as dramatic as Ryan's house, but Daniel did not get a tenant call. He did not negotiate with a contractor. He did not wonder if the next repair would wipe out 6 months of rent. His return is quieter, but quiet is not the same as weak. Year 10. Now the comparison gets interesting. Ryan's property might be worth around $470,000 if appreciation has been steady. His mortgage balance has also come down. On paper, he may have meaningful equity. But the paper number is not the whole number. If he sells, he may face selling costs. He may face capital gains tax, depending on his basis, holding period, and situation. He may also have depreciation history to account for. IRS Publication 946 explains depreciation rules, and rental property depreciation can be valuable. But it is not a slogan. Land is not depreciated. Rules matter. And prior depreciation can affect the tax picture when a property is sold. Daniel's portfolio after 10 years is about $138,000 in the simple model. That may look smaller than Ryan's equity story, but Daniel can sell part of it. He can rebalance. He can raise cash without selling the entire asset. Ryan cannot sell the upstairs bathroom to pay for a new roof. He usually has 3 choices: hold, refinance, sell. Each choice has friction. Daniel has his own tax issue. If he sells appreciated stocks in a taxable account, capital gains rules matter. IRS Topic 409 explains capital gains and losses, including the difference between short-term and long-term treatment. So Daniel does not escape taxes. He just faces a different tax machine. There is another problem with year 10. People compare Ryan's best possible real estate story with Daniel's most boring stock story. That is not fair. If Ryan had a strong local market, stable tenants, no major repairs, and a good mortgage rate, his story looks excellent. But if he had a bad tenant in year 4, a $9,000 roof repair in year 7, and a 6-month insurance fight after storm damage, the same property feels very different. The house did not change categories. The lived experience changed. Daniel has the same problem on the other side. If he stayed invested through every downturn, the portfolio math looks clean. But if he sold after a 30% market crash and waited 2 years to get back in, his result could be dramatically worse. The index fund did not fail. His behavior changed the outcome. That is why this comparison cannot just be asset versus asset. It has to be asset plus owner. Ryan's edge is control. He can improve the property. He can raise rent if the market allows it. He can refinance if rates fall. He can use debt to control a larger asset. He can turn a neglected house into a better one. But every one of those advantages requires judgment. Control is useful only if the person using it makes good decisions. Bad control is just a faster way to make expensive mistakes. Daniel's edge is simplicity. He can own pieces of many companies without managing any of them. He can reinvest dividends. He can keep costs low. He can automate the plan. He can avoid concentrating his future in one property and one local economy. But simplicity has its own trap. Because the strategy feels too easy, people start looking for something more exciting. They chase hot sectors. They jump in and out. They confuse activity with intelligence. So by year 10, Ryan and Daniel are not just competing with each other. They are competing with their own weaknesses. Ryan has to avoid underestimating costs. Daniel has to avoid overreacting to volatility. Ryan has to keep enough cash reserves. Daniel has to keep enough emotional reserves. Both reserves matter. Only one shows up in a bank account. Year 20. This is where the debate becomes less comfortable. Ryan's property might be worth around $630,000 in the illustrative model. His mortgage balance may be far lower than it was at the beginning. His equity could look impressive, maybe very impressive. Daniel's $70,000 portfolio might be around $271,000 before taxes in the same simple model. At first glance, real estate looks like it won, but the clean comparison is still not finished. Ryan's $630,000 house is not $630,000 of spendable money. He may still have a mortgage balance. He may have selling costs. He may have taxes. He may have depreciation history. He may have deferred repairs that the next buyer will notice immediately. If the property needs a $14,000 roof before sale, the buyer does not care that Ryan had a great story about appreciation. The buyer sees the roof. The inspector sees the roof. The negotiation sees the roof. Daniel's $271,000 portfolio is not perfectly clean either. If it sits in a taxable account and he sells appreciated shares, tax may be due. If the market drops right before he needs the money, the timing hurts. If he spent 20 years checking the market every morning, the emotional cost was real. But Daniel can usually sell in pieces. He can raise $20,000 without selling the whole plan. Ryan often cannot raise $20,000 from a property without debt, refinance, or sale. That liquidity difference is not a tiny detail. It changes how much freedom each person actually has. But now count what Ryan paid to get there. Vacancy months, repairs, insurance increases, property tax, roof reserves, tenant problems, bookkeeping, debt risk, concentration risk. Hundreds of small decisions that never show up in a headline. Now count what Daniel paid. Market crashes, boredom, volatility, the temptation to sell. Years where doing nothing felt irresponsible. The fear that invisible ownership was not enough. Here is the climax. Ryan may end with more visible wealth. Daniel may end with more liquidity and fewer operational scars. Or, after selling costs, taxes, repairs, reserves, and stress are counted, the gap may be much smaller than the real estate headline suggests. Two investors can end near the same financial neighborhood while paying completely different prices to get there. Ryan paid with management, leverage, concentration, and time. Daniel paid with volatility, patience, and emotional discipline. That is the real comparison. Now imagine both of them at the end of the story. Ryan has the house. He has equity. He has a story people understand. He can say, I bought this years ago and now it is worth a lot more. That sounds powerful. It can be powerful. Daniel has a portfolio. It is less impressive in conversation. There are no keys to hold up. No tenant to mention. No property photo to show. But he may have had 20 years with fewer emergency calls, fewer surprise bills, and more flexibility. That does not mean Daniel had the easier path. He had to sit through market crashes. He had to watch headlines predict collapse. He had to resist the feeling that doing nothing meant being passive in the wrong way. Ryan had to handle operational risk. Daniel had to handle behavioral risk. Both paid. They just paid in different currencies. Real estate can win. Stocks can win, but neither wins automatically. Real estate wins when the property is bought well, financed carefully, rented consistently, maintained honestly, and taxed correctly. Stocks win when the investor stays diversified, keeps costs low, does not panic sell, and lets compounding work long enough. The worst version of real estate is not owning property. It is owning a property you cannot afford to operate. The worst version of stocks is not volatility. It is selling volatility at the worst possible moment. Ryan's mistake would be counting rent checks as profit. Daniel's mistake would be thinking passive investing requires no emotional strength. So before asking, which one makes more money, ask a better question.
Static first frame with a slow push-in and one clean financial visual emphasis.
Did you count the bad tenant? Did you count property tax? Did you count insurance? Did you count depreciation rules? Did you count capital gains? Did you count liquidity? Did you count market crashes? Did you count panic selling? Did you count the hours? Because the winner is not the asset with the better story. The winner is the plan that survives the full cost of owning it. And sometimes the real difference between real estate and stocks is not which one makes more money. It is which one you can hold for 20 years without lying to yourself about what it really costs.